Our market guest then, Dipan Mehta now joins in. Dipan, hi, good morning. We have to start with L&T. Yeah. Would you buy into this weakness or would you stay on sidelines? What would be your strategy on this biggie?
I think, see, it depends upon the kind of investor you are, and if you are a long-term patient investor with a fairly sizable portfolio, then certainly I think L&T would be a stock which would gradually take it to your core holdings. And no doubt, I think the numbers have been disappointing, and it's more to do with the subsidiary profits as well as some of the orders which they're executing in the Middle East geography. But I think there are a few silver linings over there as far as the order book is concerned. And it's a great company in terms of execution and in terms of past track record, in terms of management dynamism. And there's a lot of value in the subsidiaries, which can be sold off to, to kind of unlock value and reduce debt. So lots of possibilities are there as far as L&T is concerned, and you just need to be patient. I think over 2-3 years this stock could really outperform and deliver good returns. And frankly, when you want to look at the capital goods sector, there are very few choices available of the type of L&T, so that also goes in its favor.
Well, this is just an allied stock. Just to complete the argument, I'm bringing in BHEL, Dipan. First, good morning and good to have you with us. BHEL actually has shown a remarkable resilience, considering that it has posted several quarters of numbers which are difficult to forgive. And you're not going to see a power sector expansion anytime soon. This stock, is it correctly priced? Is it overpriced?
See, it's a difficult call to make, and the fact of the matter remains that maybe some contrarian investors like the story as far as BHEL is concerned, and if you have a really long-term view and you are positive on the sector, then BHEL will certainly benefit. It's one of the bluest of blue chip PSU companies, one of the, in fact, few PSU grade companies per se. Unlikely that there'd be any major equity issuances over there from the government, and balance sheet is in great shape. So I think if you are patient enough, and when you see a recovery in the capital goods sector, not just power, but they're exposed to railways and several other segments as well, so those could start kicking in. But I think within the capital goods large cap, L&T has to be preferred over BSE.
Okay, I think we have a problem with that audio, but I think the crux of his answer was with us that you could take a bet on the longer term on BHEL as well, but L&T will have to be preferred simply because of the pedigree and better performance that the stock has shown. Dipan, can you hear us now?
Yes, I can hear you clearly.
We just lost you for a bit. Anuj, with your permission, if I can continue on this theme for a bit more. We saw diverse results from the smaller, what we consider blue chips in this space, power-related space. VATech Babak didn't produce a very good set of numbers, actually lower sales, though it's on everybody's buy list. Cummins, on the other hand, again on everybody's buy list, but really surprised with an extraordinary performance, both on margins and on revenues. And then EIL India, fairly dismal numbers. Take us through the mid-cap preferences you have in the broadly capital goods space.
See, this is the nature of the capital goods sector, and there's a degree of volatility in their earnings because the revenues are project driven, so depending upon which projects are at what level of completion, they're able to recognize the income, and there's always a lag between execution and order wins. So one of the better ways of kind of tracking the capital goods segment is to look at the order position, and if that remains pretty much stable and is growing at a rate faster than the sales, then I think investors need not worry so much, because eventually the revenues will start kicking in. And these days what we are observing is that the problems which were there about non-execution or delays of projects because of various reasons, especially government clearances, that risk has gradually receded. So let's just have an eye on the order book position of these companies, and one would be perfectly fine. Cummins, of course, is in a complete class by itself, and if you look at the last 4-5 years, even when the capital goods sector was underperforming the broader economy, they continue to do well because of the technology, because of the support of the parent company as far as exports are concerned, and they continue to expand. So I think they are there in a perfect position to take full advantage of the recovery whenever it does take place in the capital goods sector and whenever the cycle does pick up. So I would say that from an investor's point of view, it's still better to remain in the large cap capital good companies, and some of the mid cap ones like Cummins, which have a very specific edge in terms of their business model or export markets or whatever.
Okay, Dipan, one stock which is looking quite good today and is maybe celebrating the exit of maybe with Dr. Harshvardhan as the health minister, ITC. That stock is up 3% now. What's your call on this one? A good buy, or valuation-wise, is it such now?
See, that was a risk in ITC that the government could put additional pressure in terms of restrictions on consumption of tobacco, and maybe because of a change of minister, investors perceive that that's positive for ITC. But I'm not a great fan of ITC, and per se it remains a tobacco company with all its issues, legacy issues, as well as the detrimental effect it does have on the consumer. I wouldn't like to call it a FMCG company by any stretch. They haven't been able to make any of their businesses other than tobacco a success. And if you see, it still remains largely dependent on growth rates as far as tobacco is concerned. And no doubt that's a cash cow. But when you look at the entire spectrum of competing companies available for investment, one would feel more comfortable looking at some of the Indian FMCG companies rather than ITC. So I would, give it a pass for the time being. And I think, had the business been more diversified and other non-tobacco businesses shown some growth, shown profitability, shown higher return on capital employed, maybe the story would have been different. But just buying a pure tobacco company with its associated risks and moral issues is not something that we are too enthused about.
All right, since I don't have to worry about money in my current juncture, I will vote with my heart and not with my head, and agree with you on ITC completely, Dipan. Well, just a broad question for you. In the recent earnings season, what stood out for you, sectors and stocks that we have missed out? Any top 2 or 3 things that come to the mind?
Banks did very well, and I don't talk about PSU banks. Don't have a single investment over there or never recommended for past several years. But largely private sector banks, NBFCs did very well. Within NBFCs, I think microfinance companies, housing finance companies did very well. And there was a kind of a positive commentary as far as the vehicle financing companies were concerned. So that's one new kind of, I would say, not new, but at least something which had been a laggard over the past 2-3 quarters. So that segment has opened up, and lots of new ideas should come in over there. The second, I think, type of companies which did very well, and it's quite interesting because we are seeing the changing consumer pattern, consumer expenditure pattern over here, where maybe say pizzas or footwear or some of the other old-time performers are not doing well. But then I think home improvement companies have done well, the likes of tile manufacturing companies, plywood companies, laminate companies, appliance companies have done well. So I think within the consumer-oriented, there's a shift taking place, and a lot of new ideas are popping out from there as well. And then lastly, I think cement also has come out with a very decent set of numbers across the board, and that had been a laggard sector. So I would say that there's a turnaround taking place in cement as well. And with input costs coming off and prices remaining stable, you could see expansion of margin, and it's a nice play on the economy, on infrastructure and construction. So I would say I did hear your initial discussion on this earnings season not being that great, but I would slightly beg to differ, because the companies and the sectors that we are looking at, we've come out of this earnings season with many more new ideas and far more satisfied with the way the companies have delivered rather than the earlier earnings seasons.
Mm-hmm. Fair enough. That matters what investors like you and market watchers like you feel. Dipan Mehta, thank you very much for joining us with your thoughts on a wide array of stocks.